Hello and welcome to Doc's Market Minute for Monday, the 24th of January. In today's Market Minute, I'm going to show you how you can use Confluence to identify what might be a short-term bottom in the markets. All right, guys, with about 2.5 hours left in today's market, we are getting crushed today. Market's down well over 100 points to the downside, about 3%. So the obvious question here is, where are we going to find support? Well, nobody really truly knows, especially when we have a high velocity distribution move like this. Support levels that you tend to count on usually get run through. So if I want to identify some really high probability levels that I think are going to hold in the short term, what I have to do is to fall back and use a technique called Confluence. This is where we are, well, according to the dictionary definition, this is an act or process of merging. And this is where we're going to put together several different indicators or levels into one chart. Now, one of the first targets that I can see down here where the price kind of found some support today early on was the 4,200 level on the S&P futures. Notice also this gray box. This represents a gap going all the way back to June. So these gaps can become a target for no other reason than the best definition that I've heard of gaps being filled is in a sea of sand, a single red flag that stands up becomes a target. So these gaps tend to get filled for no other reason than the fact that everyone sees them and they become a target. The other thing that we see here too, aside from the gap, is that it's a nice round number. So round numbers tend to be targets in support and resistance. Okay, so we've got two metrics now, not only the gap, but also a big round number at 4,200. What else can we find that's price related that represents support? Sometimes the best thing that you can do is to zoom out. In this case, what I've done is I've taken the weekly chart on the S&P futures, and what I'm going to do is draw a Fibonacci retracement of the latest great big weekly swing, and this goes all the way back to September of 2020. You can see clearly this is the last launching point down in this area around 3,200 or so before we had all of this 2021 swing to the upside. And so we're going to draw those fibs from the beginning to the end of that move. And what we're going to find is that we're going to see the price coming down to that 38.2% retracement right here at 38.2. And it's right around the 4,200 level. Technically, it's coming in at about 41.87, but a confluence area is not necessarily a single price point. It is, as I say, an area. It is a collection of similar technical indicators that tend to reinforce each other. Now let's go one better. Let's go all the way to the bottom of the pandemic move in March of 2020. And we're going to draw the same fibs here from bottom all the way to top. And guess what just happened here? We also have another fib level, which is coming in at Confluence, which is the 23.6. And this is the 23.6 retracement of the entire swing. Typically, I don't see big reactions at 23.6, but when you combine a 23.6 of the entire move with a 38.2 of the major swing, all of a sudden we have a level which is starting to become very, very powerful right here at 4,200. Now, the next thing that I might add to this could be volume profile, but you'll notice that I'm not adding any delayed indicators like stochastics or MACDs or RSIs or anything else that is a trailing indicator. That to me doesn't necessarily represent support. Notice how the 200-day moving average just got knifed through a couple of days ago like it didn't even exist. To me, price levels are much, much more important than any kind of trailing indicator that we're going to apply to the chart. That's it for today's Market Minute. Thanks for listening. See you tomorrow.